All right, everyone, get ready for another deep dive. Today is January 28th, 2025, and we're going to be talking all about financial markets and earnings season. And let me tell you, things are already pretty interesting. We've got some breaking news out of China that's kind of shaking things up globally.
Yeah, it's pretty wild how fast markets can react, especially when it comes to AI. Everyone's on edge.
That's for sure. So what's causing all the commotion this time? Well, it's a Chinese startup called deepsec. They just went and launched a new AI model, and the market is not exactly thrilled. NVIDIA, especially. Their stock price has taken a pretty big hit.
Makes sense if you think about it. NVIDIA is a big player in AI hardware, right? And if this new technology from DeepSec is really as game-changing as people are saying, then, well, you can see why NVIDIA's growth projections might take a hit. It's like that old saying, sell first, ask questions later. You see that a lot, especially in a sector like AI, where valuations are sky high.
So what's so special about this deepsec AI anyway? I mean, what are the big questions that analysts are scrambling to answer right now?
Well, we're still waiting for all the details, but the early buzz is that this AI from DeepSec is more efficient, more powerful too than anything we have here in the US. And that could be a real game changer. One of the biggest questions is about the hardware they're using. Like, are they just using Chinese GPUs or is there some US tech in there too? The answer to that question could have some pretty huge implications, not just for AI, but for the whole global tech landscape.
Yeah, it's almost like a tech arms race, isn't it? You've got the US and China constantly pushing the boundaries of what's possible.
Absolutely. It's always been a pretty intense competition between US and Chinese tech companies, and this just raises the stakes even higher, I think. We're talking about the future of technology here. It's a big deal.
For sure. So while that AI story is still developing, let's turn our attention back here to the U.S. We've got the Federal Reserve meeting this week. What should we be keeping an eye on?
So the general consensus is that we won't see an interest rate cut at this meeting. But don't tune out just yet. The real action might be in the Q&A afterwards. The market is going to be laser focused on anything at all that Powell might say about future cuts. It's all about reading between the lines with these things.
Yeah, like a game of financial charades, right? Everyone trying to decipher the Fed's every word. Right now, the market's only giving a 28% chance of a rate cut in March. But hey, depending on what Powell says, who knows?
Definitely. And we can't forget about the December PCE inflation data that's coming out this week, too. And forecasts are pointing to a possible uptick, which, that could definitely add to the market volatility we're already seeing.
So we've got breaking news from China. We've got the Fed meeting and all the suspense that comes with that. And we've got potential inflation surprises lurking around the corner. It's a lot to process all at once.
Ooh.
But if you had to pick one thing, just one thing that will have the biggest impact on the markets this week, what would it be?
Earnings reports, without a doubt. This week, we've got some of the biggest names in tech reporting. Apple, Microsoft, Tesla, Meta. What they say, what they forecast, I think that's going to have a much more immediate impact than the broader economic data points we've been talking about.
Makes sense. All right, let's shift gears then and dive into earnings season. First up, Apple. Their stock hit an all-time high just last month, but it's come down a bit since then. What's the current thinking on Apple's valuation as they head into earnings?
Well, even with the recent dip, Apple's still trading at a premium, at least according to Morningstar's analysis. But it's not just hype. Apple's got an incredibly loyal customer base, and they've built an ecosystem of products and services that people rely on day in and day out. It's like an economic moat, a really wide one, and it makes it really hard for competitors to steal market share.
So it's like a fortress of profitability built on iPhones and Macs and the Apple Watch and all those services they offer. But even with that, there are still some key questions investors are going to be asking as we head into earnings, right?
Absolutely. People want to know about iPhone sales, especially in China, where they've been facing some stiff competition. Service revenue will also be under scrutiny, as it's been a major growth driver for Apple in recent years. And then, of course, there's Apple Intelligence.
Apple Intelligence. Now, that's one I haven't heard before. What is that exactly, and why should investors care?
Basically, it's their suite of AI and machine learning technologies, the things that power Siri, facial recognition, all this predictive analytics they use. Investors are going to be listening for any hints about how Apple Intelligence is evolving, how it might drive future growth, whether it's through enhanced user experiences or maybe even entirely new service offerings.
Sounds like Apple's future hinges on how well they can leverage AI, not just in their products, but across their whole business strategy.
I think that's a fair assessment, and it's a theme you'll see play out across the whole tech sector as we go through earnings season.
Okay, next up is Microsoft. Now this one, I know this is a favorite of yours. What is it about Microsoft that makes them so special?
Oh, where do I even start? They've got a hand in so many profitable areas. Cloud computing with Azure, productivity software with Office 365, gaming with Xbox, social media with LinkedIn. It's a really diverse business model. Plus, they have incredibly strong brand recognition, a culture of innovation, and it all adds up to a wide economic moat. It's
Mhm.
almost impossible for competitors to take market share from them.
It's like they've built this tech empire with all these different kingdoms contributing to their overall strength. And of course, they're in a prime position to capitalize on the whole AI revolution too, right?
Exactly. Microsoft's cloud infrastructure, Azure, it's a powerhouse for AI. And they're investing a ton in AI research and development. Plus, they're integrating AI into pretty much all of their existing products and services. It's a smart strategy.
Speaking of AI, I'm curious about how Microsoft stacks up against this new threat from deepsec. Are they worried about this Chinese startup stealing their thunder?
Well, Microsoft's a giant, right? It's
Yeah.
not going to be easily dethroned. But that being said, DeepSec's arrival on the AI scene is a wake-up call. Microsoft can't afford to be complacent. They've got to stay on top of their game, keep innovating if they want to stay in the lead.
It's a constant race to stay ahead. Okay, let's move on to a company that's definitely been generating a lot of buzz, Tesla. Their stock is up over 65% since the election. It's been on a tear. But the big question is this sustainable?
That is the million-dollar question, isn't it? Right now, Tesla's price is way above Morningstar's fair value estimate. Like, we're talking roughly double what it's actually worth.
Double. Wow, that's a pretty big gap. So with such a high valuation, what are investors going to be scrutinizing most closely in Tesla's report?
A few things, really. Gross profit margins, that's a big one. Progress on their self-driving software, how's that coming along? Any updates on the timeline for the Model Q, their more affordable SUV? That's another key factor a lot of analysts are watching. And then there's the growth potential of their energy storage business. Could be a major contributor to their long-term profitability.
So lots to watch there. Okay, last of the tech giants we're covering today, Meta. Interestingly, Morningstar actually raised their fair value estimate for Meta recently, which is not something you see every day, especially with all the challenges they've been facing.
You're right, it is kind of surprising. That increase was mostly driven by a change in outlook on U.S. ad revenue. Morningstar analysts are thinking that advertisers might be looking to move away from TikTok a bit and spread their spending around more, which could mean more dollars flowing to platforms like Meta.
So Meta might actually benefit from TikTok's troubles,
Yeah,
but let's be honest, they're not out of the woods yet, are they?
definitely not. Meta's got a lot to prove. I'll be paying close attention to their capital expenditure plans, especially anything to do with AI investments. How are they integrating AI into their ad targeting? What about content creation? Those are key questions.
Their AI initiatives have been getting a lot of attention, especially after those heavy investments in the metaverse, which haven't really panned out as they'd hoped.
Yeah, for sure. The market wants to see that Meta's AI spending is actually leading to some tangible results. I'm also curious to hear about any changes to their content moderation policies, especially how those align with the EU's Digital Services Act. Oh, and one last thing I'll be watching for, any hints of further workforce reductions. They've already had a few rounds of layoffs, and investors want to know if there are more cost-cutting measures on the horizon.
Okay, so we've got those big earnings reports to look forward to this week. But before we jump into some notable reports from last week, I want to get your take on something. We've talked about Apple, Microsoft, and Meta all going all in on AI. But then we have this news about deepsec potentially disrupting the market. Do you think these big tech companies are doing enough to stay ahead, or are they in danger of falling behind?
That's the question, isn't it? The AI landscape is changing so fast, the competition is fierce. These big tech companies, they've got resources, they've got talent, but they can't afford to get complacent. They have to be agile, innovative, really on the ball if they want to maintain their dominance.
Like a high-stakes game of chess, with each company trying to predict the other's next move.
That's a great analogy, and the stakes are incredibly high. The winners of the AI race, they're the ones who are going to have a huge advantage in the years to come.
All right, let's take a quick trip back in time and look at some notable reports from last week. We had banks, oil, telecom, even entertainment releasing their numbers. Where should we start?
Let's start with the big banks. It's interesting. Things are going pretty well for them right now. Strong earnings growth expected and all that. But, I'm not sure the market is being realistic about how long this good times party can last.
That's an interesting perspective. Why do you think the market might be getting a little ahead of itself?
Well, interest rates are still low, which is good for banks, obviously. but the economy is showing signs of slowing down. And there's always the risk of something unexpected happening, a global recession, a geopolitical crisis, something like that. Things that could really put a dent in bank earnings.
So proceed with caution if you're thinking about investing in banks. Were there any specific reports last week that caught your eye, either good or bad?
U.S. Bancorp had kind of a so-so report, I guess you could say. Earnings met expectations, but their loan growth was pretty weak, and their expenses were higher than people had hoped.
Not terrible, but not setting the world on fire either. Sounds like the market's waiting for more proof that U.S. Bancorp can really get their costs under control and improve performance before giving them a thumbs up.
Yeah, exactly. They've got some work to do.
Okay, let's move on to energy. What are your thoughts on the oil sector right now? It's been kind of a roller coaster ride the last few years.
Morningstar is actually viewing the energy sector favorably right now, especially as a hedge against inflation. Oil prices have been relatively stable lately, and demand is still strong, especially in emerging markets. We're seeing good value in some of the larger integrated oil companies like ExxonMobil and Chevron.
Interesting. Between those two giants, do you have a favorite? Which one do you think looks better right now?
At the moment, ExxonMobil seems more appealing. Their discount relative to Morningstar's fair value estimate is a bit higher.
So for the bargain hunters out there, ExxonMobil might be the way to go.
Yeah, they're both solid companies, but if you're looking for value, ExxonMobil might be the better bet, at least right now.
All right, let's talk about telecom. Verizon reported pretty solid numbers last week, beat expectations. What's the story there?
Yeah, good results, though not exactly mind-blowing. The big takeaway for me was their focus on raising prices rather than just chasing subscriber growth. It seems like they're more interested in squeezing more value out of their existing customer base than just adding new subscribers at any cost.
But isn't that kind of a risky strategy in such a competitive market? I mean, the telecom industry is notorious for those aggressive promotions and price wars.
It's definitely a different approach than what we're used to from Verizon. They're basically betting on their network quality, their brand reputation, hoping that'll be enough to convince customers to stick around, even if their prices are a bit higher than the competition. It's a bold move, no doubt. We'll have to see if it pays off.
It's like they're saying, we're Verizon, we're the best, and you're going to pay for it.
Prockles. Yeah, something like that. But even with this approach, their stock is still considered undervalued by Morningstar. And they offer a high dividend yield, which could be pretty appealing to investors looking for income.
A potential value play, then. Okay, let's talk about entertainment. Netflix had an absolute blowout quarter, didn't they? They crushed expectations for both subscriber growth and margins.
They did. It was pretty remarkable. They exceeded even the most optimistic forecasts. And a lot of it had to do with their crackdown on password sharing. Turns out it actually boosted subscriber growth.
So sharing is not always caring, at least not when it comes to Netflix's bottom line. But is this enough to make Netflix a buy now?
Well, even after that impressive performance, Morningstar did increase their fair value estimate by a good 27%, but the stock is still trading at a significant premium, probably about 40% above their estimate.
So still a bit pricey for the value investors out there, but definitely a company to keep an eye on. Okay, before we move on to your expert picks for this week, let's touch on a couple more reports from last week. What's the latest with Johnson & Johnson?
Well, the market wasn't too happy initially about their anticipated slowdown in growth due to competition from biosimilars for their drug Stelara. But the stock has recovered since then. What I find interesting is that J&J's long-term guidance is actually really optimistic. They're projecting revenue growth of 5% to 7% from 2025 to 2030.
Wow, that's pretty impressive, especially considering the headwinds they're facing. It's way higher than what Morningstar is projecting for them right now.
It is, and if J&J can actually achieve that kind of growth, there could be a lot of upside potential for the stock.
So a potential opportunity for those who believe in their long-term vision.
Exactly.
Okay, last one, a quick update on Edison International. We talked about them a few weeks back when those California wildfires were impacting their territory.
Right, the stock is still under some pressure because of those ongoing wildfire issues. But Morningstar's analysts are pretty confident that shareholder exposure will be minimal. They're sticking with their fair value estimate for Edison, and they see the current discount as a possible buying opportunity.
So, a bit of a contrarian play, but if Morningstar is right, it could pay off.
Exactly. It's all about weighing the risks and rewards carefully.
Okay, that makes sense. Wow, we covered a lot of ground just now. But now it's time to hear your expert picks for stocks to watch this week before earnings. What's first on your list?
Well, first up, we have Advanced Micro Devices. You might know them better as AMD.
AMD. You actually highlighted this one a few weeks ago, right? They're in a great position in the AI semiconductor market.
They are. They're projected to be the #2 player in AI semiconductors, just behind NVIDIA. And even though their stock has dropped about 40% from its peak in 2023, we still think AMD is undervalued. There's a lot of growth potential there.
So you're going against the grain here. What makes you so confident, despite what the market seems to be saying?
Well, I think the market might have overreacted to some short-term concerns about PC sales slowing down and competition from Intel, but I'm confident AMD is in a good spot to benefit from the long-term growth and demand for AI chips. And their data center business is doing really well, too.
So you see this dip as a buying opportunity.
I do.
All right, what's pick number 2?
My second pick is Nutrien, a leading fertilizer company.
Nutrient, huh? Now, fertilizers haven't exactly been the hottest sector lately. What makes them stand out?
We're expecting Nutrien to benefit from a rebound in fertilizer volumes and prices. They've been pretty depressed for a while now. The agricultural industry is cyclical, and we're starting to see signs of a turnaround.
So you're betting on a cyclical recovery in the fertilizer market. What are some of the factors that are pointing in that direction?
Well, for one, grain prices have been going up, which is good news for farmers. It should encourage them to plant more, which means they'll need more fertilizer. There have also been some disruptions in the fertilizer supply chain, which will likely push prices up.
So it's a combination of increasing demand and a tighter supply. Got it.
Right. And then there was that recent news about a major potash producer cutting production. That should support further price increases, making Nutrien look even more attractive.
So Nutrien's a bit of a contrarian play, but the underlying story makes sense.
Yeah, that's fair to say.
Okay, what's your final pick for this week?
My last pick is Barrick Gold, the world's second largest gold miner.
Barrick Gold. Now, gold had a great run last year in 2024, but Barrick's stock didn't really follow suit. What happened there?
They had some company-specific issues last year. Production was down, capital expenditures were up, and then they had that tax dispute in Mali. All of that combined led to a pretty big discount in their stock price.
So kind of a rough year for them. What makes you optimistic about Barrick Gold now?
Well, we think those issues are temporary. More importantly, we think they're already factored into the current stock price. As they work through those challenges and increase production, we expect their earnings to improve, and that should lead to a higher stock price.
A potential turnaround story, then.
Exactly. And what's really intriguing is that if gold prices keep rising, which is contrary to what Morningstar is predicting, then Barrick Gold could have even more upside potential.
All right, we've covered a lot of ground in this first part of our deep dive. Breaking news from China, the Fed meeting, big tech earnings, your expert picks. It's been a whirlwind. But before we move on to part 2, where we'll dig deeper into some of these themes and trends, I want to leave our listeners with something to think about. We've seen how quickly markets can react to news and events. Sometimes it feels like they're swinging wildly from optimism to pessimism and back again. But as long-term investors, how do we filter out the noise and focus on what really matters?
That's the million-dollar question, isn't it? It's so easy to get caught up in the day-to-day drama of the market, but it's important to remember that investing is a marathon, not a sprint.
Absolutely. So as we head into part 2, keep that in mind. What are the long-term trends that are shaping the market? What are the companies that are positioned to benefit from those trends? And most importantly, how can you build a portfolio that reflects your individual goals and risk tolerance?
Those are great questions to consider. We'll be exploring some of those themes further in part 2.
Sounds good. We'll be back soon with more insights and analysis. Until then, happy investing. All right, let's shift gears for a moment and talk about some of the reports that came out last week. There were some interesting developments, especially in the banking sector.
Yes, the banking sector is always worth keeping an eye on, especially in light of recent events.
Right. So last week, U.S. Bancorp had a somewhat lackluster report. It wasn't terrible, but it wasn't great either.
Their earnings were in line with expectations, but their loan growth was a bit weak, and their expenses were a bit higher than analysts had hoped for.
So not a disaster, but definitely not a reason to celebrate either.
Exactly. The market wants to see more evidence of cost control and improved performance from U.S. Bancorp before rewarding them with a higher valuation.
It's a show-me story, for sure.
Definitely.
Okay, let's move on to a completely different industry. Entertainment. Specifically, Netflix. They had a phenomenal quarter, smashing subscriber growth and margin expectations. In fact, Morningstar raised their fair value estimate for Netflix by a whopping 27%.
Yes, the results were truly impressive. Their crackdown on password sharing, which many thought would backfire, actually boosted subscriber growth.
So it seems like Netflix finally realized that sharing isn't always caring, at least when it comes to their bottom line.
Yeah.
But is this enough to make Netflix a buy now?
Well, even with the increased fair value estimate, the stock is still trading at a significant premium, about 40% above Morningstar's estimate.
So still a bit rich for value investors, but it's definitely a testament to Netflix's ability to adapt and innovate.
Absolutely. They've been a leader in the streaming space for a long time, and they continue to find ways to grow and evolve.
Okay, let's talk about another company that's been in the news lately, Johnson & Johnson. They faced some initial concerns about a potential slowdown in growth, but their stock has since bounced back.
Yes, the market was initially concerned about competition from biosimilars for their drug Stelara. But it's worth noting that J&J's long-term guidance is quite optimistic. They're projecting 5% to 7% revenue growth from 2025 to 2030.
That's impressive, especially considering the headwinds they're facing. It's significantly higher than Morningstar's current growth projections for them.
It is. And if J&J can deliver on that guidance, there could be significant upside potential for the stock.
So a potential opportunity for investors who believe in their long-term strategy and their ability to innovate.
Exactly. J&J has a long history of innovation, and they have a deep pipeline of new products in development.
Okay, let's get a quick update on Edison International. We talked about them a couple of weeks ago in the context of the California wildfires impacting their territory.
Right. The stock continues to face pressure due to the ongoing wildfire situation. But Morningstar's analysts believe that shareholder exposure will likely be minimal. They're maintaining their fair value estimate for Edison and see the current discount as a potential buying opportunity.
So a bit of a contrarian play, but one that could pay off if Morningstar's analysis is correct.
That's right. It's a situation where you have to weigh the risks and potential rewards carefully.
Okay, that makes sense. Now, before we dive into your expert picks for the week, I want to circle back to a topic we touched on earlier, AI. It seems like every company we've talked about today is investing heavily in AI. It's almost like it's the magic ingredient that everyone is trying to add to their recipe for success. But with all this hype around AI, are we at risk of another bubble?
That's a great question. It's definitely true that there's a lot of hype around AI right now, but I think it's important to distinguish between hype and reality. AI is a transformative technology with the potential to revolutionize many industries.
So it's not just a fad.
Yeah.
It's a fundamental shift in the way we do things.
Exactly, and that's why so many companies are investing in it. But it's also important to remember that not every company that's investing in AI is going to be successful. There will be winners and losers in the AI race.
So how can investors separate the wheat from the chaff? How can we identify the companies that are truly leveraging AI to create value as opposed to those that are just jumping on the bandwagon?
That's a great question. I think it's important to look beyond the headlines and the hype. You need to dig deeper and understand how a company is using AI and how it's integrating AI into its overall business strategy.
So don't just invest in a company because they say they're doing AI. Look under the hood and see how they're actually using it.
Exactly. And remember, AI is not a magic bullet. It's a tool that can be used to create value, but it's not a guarantee of success.
All right, with that in mind, let's move on to your expert picks for the week. What's the first company you want to highlight?
First up, we have Advanced Micro Devices. You might know them better as AMD.
AMD. We talked about them a few times already today. They seem to be a company that's firing on all cylinders. What makes you so bullish on AMD?
AMD is a leading designer and manufacturer of microprocessors, graphics processing units, GPUs, and other semiconductor devices. They're a major player in the PC market, and they're also gaining share in the data center market, which is a huge growth opportunity.
So they're a diversified semiconductor company with a lot of irons in the fire. What are some of the key factors that you believe will drive their growth in the years to come?
Well, for one thing, they're benefiting from the strong growth and demand for GPUs, which are used in a wide range of applications, from gaming to artificial intelligence. And they're also well-positioned to capitalize on the growth of the data center market, which is being driven by the increasing adoption of cloud computing.
So they're riding some powerful secular growth trends. What about their valuation? Is the stock still a bargain after its recent run-up?
According to Morningstar's analysis, AMD is still undervalued, even after its recent run-up. They have a strong balance sheet and a solid management team, and they're generating strong free cash flow.
So you see a lot of upside potential in AMD, even at these levels. Interesting. Okay, what's your second pick?
My second pick is Nutrien, a leading fertilizer company.
Nutrien. We talked about them earlier in the context of rising food prices and the growing global population. What makes them stand out in the fertilizer industry?
Nutrien is the world's largest producer of potash, which is a key ingredient in fertilizers. They also produce nitrogen and phosphate fertilizers, so they're a diversified player in the industry.
So they're a one-stop shop for farmers' fertilizer needs.
You could say that.
What are some of the key drivers of growth for Nutrien?
The global population is growing, and that means there's more demand for food. To produce more food, farmers need to use more fertilizer. Additionally, rising incomes in developing countries are leading to dietary changes, with people consuming more protein, which also requires more fertilizer to produce.
So they're benefiting from some powerful long-term trends. What about their valuation? Is the stock a good value right now?
According to Morningstar's analysis, Nutrien is currently undervalued. They have a strong competitive position in the fertilizer industry, and they're generating strong free cash flow. They also have a good track record of returning capital to shareholders through dividends and share buybacks.
So a potential value play with a nice dividend yield, that's always appealing. Okay, what's your final pick for the week?
My final pick is Barrick Gold, one of the world's largest gold mining companies.
Barrick Gold. We discussed them earlier in the context of their recent challenges, including lower production and a tax dispute in Mali. But you seem to believe that those challenges are temporary and that the company is poised for a turnaround.
I do. Barrick Gold is a well-managed company with a strong track record of profitability. They've faced some headwinds recently, but I believe they're well-positioned to overcome those challenges and return to growth.
What are some of the key factors that support your bullish thesis on Barrick Gold?
Well, for one thing, gold prices have been rising recently, and that's good news for gold mining companies. Additionally, Barrick Gold has a strong portfolio of assets, including some of the world's largest and lowest-cost gold mines.
So they're a low-cost producer in an industry with a favorable pricing environment. That's a powerful combination.
Exactly. And according to Morningstar's analysis, Barrick Gold is currently undervalued. They have a strong balance sheet and a solid management team, and they're generating strong free cash flow.
So you see a lot of upside potential in Barrick Gold, just like you do in AMD and Nutrien.
That's right. I think all three of these companies are solid long-term investments.
Okay, we've covered a lot of ground in this second part of our deep dive. We've explored some key themes and trends in the market, we've revisited some notable reports from last week, and we've heard your expert picks for stocks to watch before earnings this week. Now, in our final segment, we'll wrap things up with some key takeaways and some food for thought for our listeners as they navigate the always exciting world of financial markets.
I'm looking forward to it.
We'll be back soon with more insights and analysis. Until then, happy investing. All right, welcome back to the final part of our deep dive. We've covered a lot of ground today, from that breaking news out of China, all those economic indicators, earnings reports, expert picks. We've been all over the map.
Yeah, it has been quite a ride. But I think we've managed to highlight some pretty important trends and opportunities for investors.
Absolutely. So in this last segment, let's try to distill some key takeaways from our conversation. Big picture stuff, What are the major trends that investors should be keeping an eye on as we move through 2025?
Well, I think the big theme, the one that's woven through everything we've talked about today, is the incredible speed of technological innovation. Think about it. AI, renewable energy, genomics, it's all changing so fast. The world's changing fast, and it's the companies that are able to keep up, to adapt, and innovate that are the ones that are really going to succeed.
So you're saying it's not enough to just invest in the companies that are doing well today. You need to be looking at the companies that are setting themselves up for the future.
Exactly. Look for companies with a proven track record of innovation, a strong management team, and a clear vision for where they're headed. Those are the kinds of companies you want to bet on.
Okay, that makes sense. We also spent a lot of time talking about valuation today. There's this ongoing debate about whether the market is overvalued or undervalued. What's your take on the current market environment? Are we in a bubble?
Well, it's true that valuations are pretty high in some sectors, but that doesn't mean there aren't good opportunities to find value out there. You just have to be more selective, focus on companies with a strong competitive advantage, a good history of profitability, and of course, a reasonable valuation.
So it's all about striking that balance between growth and value.
That's a good way to put it. And don't forget, investing is a long game. You don't want to get too caught up in the day-to-day ups and downs of the market. Find those high-quality companies, the ones you believe in, and hold on to them for the long haul. That's how you build real wealth.
That's great advice. And speaking of long-term investing, any final thoughts you want to leave our listeners with as they continue on their investing journey?
I think the most important thing is to have a plan, a real plan. Know what your goals are, Know how much risk you're comfortable with, and do your research. Don't just follow the herd. Figure out what works for you, what aligns with your values and your financial goals.
I love that. Have a plan, do your homework, and invest for the long game.
Exactly.
And it's important to remember that investing doesn't have to be this scary, complicated thing. There are so many resources out there to help you along the way.
Absolutely. You've got books, websites, podcasts like this one, even financial advisors if you need more personalized guidance. Don't be afraid to ask for help.
Well, I think it's safe to say this has been a pretty insightful deep dive into the world of financial markets. We've covered a lot, and I hope our listeners found it valuable.
It's been great being here. I always enjoy these conversations.
I'm so glad you could join us. And to our listener, thank you for tuning in. We hope you found our deep dive informative and hopefully even a little bit entertaining.
Keep learning, keep exploring, and as always, happy investing.
That's a wrap, everyone. We'll catch you next time.